Small Business Development Center. I will bring up my PowerPoint presentation and we'll begin. How's that? So let me start sharing my screen. I assume everybody can see it?
Yes, sir.
Okay, so it says that this meeting is being recorded. Great. Okay, so let me start the presentation. And let me minimize this over here. Okay, now we're set. All right, so again, this is Buying a Business Part 2. I'm Neil Schneider. I'm an MBA, CPA, and CVA. CVA stands for a Certified Valuation Analyst. You can see my email address. If you want to send me an email, that's great, after the presentation. As we speak, I'm still bringing people into the meeting. So here we go. In conjunction with the Small Business Development Center, this presentation is with the Small Business Administration. And I'll let Allie take it from here.
Good morning, all. Thank you so much for being with us here today. Thanks so much for the SBDC for being such amazing resource partners and bringing this special webinar to you all directly. My name is Aileen Fernandez. I'm the Outreach and Marketing Specialist. Been with the SBA for a little bit over 4 years. And previously worked with the United States Senator for a little bit over 8 years and have some private sector as well experience, master's in psychology and professor and adjunct at FIU since 2014, born and raised in Miami. Just a pleasure to be here with you all today. Again, Neil, he'll go ahead and give a little bit information more about himself, but he is a great partner to the SBA and just grateful to be here with you this morning.
Great, thank you very much. And so what is the SBDC? The SBDC is a program nationwide that is sponsored and in part, or a major part, supported with funds from the Small Business Administration. What do we do? Well, we do a lot of things in addition to no-cost consulting to small businesses. So we're around here at all the SBDCs. Our SBDC at Florida Gulf Coast University has approximately 18 consultants, and we work with clients on every area of starting, running, and growing a business. We also have a division of our SBDC that helps you get government contracts and also with exporting your products outside the state in which you're in and outside the United States. Again, the emphasis is we're no cost, confidential, one-on-one assistance for all stages of being in business. So you should tap the resources if you're on the East Coast in the Miami area or any place else, Jacksonville. There is an SBDC in every area, mostly at higher education institutions like colleges and universities, like we're at the Florida Gulf Coast University. So tap your resources. You can go on to the website and you can put in your zip code, your location, and locate the different SBDCs around the state of Florida and around the country. So this is who I am. This is my email address. You can connect with me there. What do I do for the SBDC? Well, I help them with mostly financial stuff, cash management, succession planning, exit planning. I help the bankers and the SBA get the small business financials together. I do a lot of QuickBooks training for new businesses that want to get into financial statements and keeping the records accurate. And also I put in some tax webinars during the end of the year to have small businesses understand their tax implications, and also when they start out to understand that, hey, if you're going to organize your business legally in the state of Florida, you need to understand how that affects your tax implications for your business. Last thing before we get started is a disclaimer that I am not giving tax advice or any legal advice, but I'm just providing some information so that you can take forward to your professional advisors. And here we go. If you were on last week's webinar, we talked about the non-quantitative factors, such as buying a business in the areas of learning who the competition is in the marketplace, the future community development in the marketplace, the DEO, or the development of the county or city's environment, legal commitments, the union contracts, the building, and which means the leases, the rents that you have to pay, and all that kind of stuff, learning about the business in which you are thinking about buying. Today, we're going to be talking about the quantitative issues. And the quantitative issues start out with number one. Are you going to buy go through an asset sale, or are you going to go through a stock sale? Two major differences in buying a business. Major differences. 99% of the sales of a business are going to be an asset sale. Why? Because you're going to buy the assets of a business. So you're going to buy possibly their inventory, possibly their fixed assets, equipment, and possibly other things that they have, such as goodwill. A stock sale is quite different. A stock sale means that you're just stepping in the shoes of the current owner, which means that you're taking on all the responsibilities of that business, and you're just another stockholder. It's no different than if you go out there and buy stock in Chase Bank or JP Morgan. You're just another stockholder. So the big difference is you're going to be a big stockholder in this company, and possibly the existing stockholder is going to be bought out by you. What does that mean? You are now acquiring all the baggage of that company because you are now the stockholder of that company. All the litigations, all the debts, all the liens, and everything else that that company has that's been disclosed or not disclosed, you are now responsible because you're now the new stockholder. Quite different than an asset sale. It's very, very dangerous to do a stock sale, to buy a company through a stock sale. And that's a whole different environment, but it was a beginning that I thought was important to start with. So getting through that of how you're going to buy that business, whether it's going to be an asset sale or stock sale, let's talk about number one. If you're thinking of buying a business, the first thing you're going to have to do is sign an NDA. What does an NDA require you to do? It's a non-disclosure agreement. That non-disclosure agreement allows you to get all the confidential financial information of that company. In other words, you can get all the customer data, all the vendor data, all the confidential information, and all the financial information from that company. What it doesn't do for you is it doesn't require you to buy the company. It only allows you to access the information because you have signed a document swearing that you will not disclose any of the information that you are getting. But it does not require you to buy the company. I just want to make sure that you understood that. Should I buy a franchise or not a franchise? Well, you know, there's a lot of people that like to buy franchises because they're buying already a model that maybe has already been proven successful. Maybe not, but they have a brand manager, and probably they have some pretty goodwill. And consequently, a lot of people like to buy a franchise, but you have to understand that buying a franchise has a lot of baggage that comes with it. That means that it has a lot of rules and regulations that you need to follow because you are now in contract with somebody else who is the franchisor. And consequently, you are not 100% free to do whatever you want to do. It might be easier to get financial data because the franchisor has a lot of financial data that they collect from the franchisees, in which you might be buying that franchise from that franchisee, but you still must do all your due diligence. And this webinar focuses on due diligence. It's the same process, doesn't change. There are no shortcuts in buying a business. and it's still a small business. In other words, a franchise may be nationwide or global, but you're still a small business in the respect that you are operating within your geographic area with your clientele and with your reputation that you're going to develop, and you're just using the goodwill, the brand of that franchise or. But you have to realize that you are also just a small business within the community in which you're operating. So you still have to act like a small business within that community. There's a lot of people out there that sell franchises. There's a lot of franchise brokers, as they call them, very similar to business brokers. What you have to realize is that a franchise broker is no different than a real estate broker. They make a commission if you sell, if you buy one of the franchises that they represent. That's the key operative, that they represent. In other words, a franchise broker does not necessarily have contracts with every franchise available. So they're going to certainly push the ones that they get commissions off of and that they represent. So if you're going to look at a franchise to buy, you need to look at different brokers that represent different franchises. And again, do your due diligence. So this is something that I pulled off of a file, of which I'm not going to read to you because you're going to be getting this slide presentation. But these are, believe it or not, 3 different pages of due diligence that should be done if you're going to think about buying a business. You have to look at the organization, you have to look at the financials, you have to look at the assets that are being offered to you. If you're buying the real estate, you need to look at the real estate and the value of it. If you're buying intellectual property, you need to do a lot of real due diligence on that. You have to understand the employees. You got to understand what licenses they operate off of, if there are any environmental issues. And of course, we never forget about taxes. Taxes are a very key element there. A lot of work to do. A lot of work to do if you're going to think about buying a business. Do you have to do it? Well, people don't have to do anything really in life except pay taxes. But the reality is you should do all these things, and you should go through them and make sure that you have satisfied yourself, that you have done your due diligence to decide whether you want to buy that business or not. At the SBDC, we work with clients that do want to buy businesses, and we sometimes show them where they might not want to get involved in that business. And sometimes they make the decision and call us back and send us an email and say, hey, you know, thanks for helping me decide not to buy that business. Sometimes you need a third person to look a little bit further outward, and you've got to get your emotions out of that decision. You've got to get your emotions out of that decision. So to summarize this due diligence in those 4 different slides, we have to review all the financial information of the business that we're thinking about buying. We have to review all the contracts. We've got to verify the business structure and the operations. We got to review all physical assets, review all employee information and contracts, and we'll talk about all these things. And we have to check all legal issues and review intellectual property rights. A lot of work to do, a lot of work to do. But if you want to make sure that you've made the right decision, or to increase your chance of not failing or not making a wrong decision, these things should be identified. And it takes a lot of work, a lot of work. And this presentation is going to help you find out where to find this information and what to look for. So now all the work begins. The first thing we have to do if we're thinking about buying a business is to get the last 3 years of tax returns. In addition to that, we need the last 3 years of income statements. They call them the profit and loss statements or the income statements. Last 3 years of balance sheets, and the last 3 years or the last year of the statement of cash flow. All these statements The income balance sheet and the statement of cash flows are all available if you're using a software package like QuickBooks, Xero, or any of those financial packages that businesses use. They can easily be obtained and printed out and obtained and given to you. I personally like them to given to me in an Excel format so that I can then massage them. I can play with them, and I'm going to show you how to do that. The reason you need the income statements and the tax returns because they are quite different. We know that there's information on the tax return that there is not information on the income statement, and we know the vice versa. We also know that income statements aren't necessarily 100% accurate, but we also know that it's most likely that people are not going to put inaccurate information on a tax return and send it to the IRS. So it's interesting to notice the differences between the income statement and balance sheet and the actual tax return. It's at this point in time, what we do is we need to bring in our tax advisors and our accountants to be able to help us, and the SBDC, if you to help us understand the information that's on these reports. Now, what we do is we then adjust the financial statements, and I will show you how it's done. We take the financial statements the seller gives us and we reconstruct them. Why do we reconstruct them? Because we're not buying the history of this company, we're buying the future of this company. So consequently, we want to project what this company would look like if we owned it. And therefore, we reconstruct the financial statements. And this is a reconstruction of financial statements. Notice that in the left right-hand area, and I hope you can see my mouse, in the left right-hand area, we have the actual financial statements, or actually the tax return of a particular company. And if you look at the bottom in the red area, it shows that they lost $806. Okay? And the reality is, if you look at the adjustments, those are adjustments that we made because we think that we are either not going to have those expenses or we are going to have different or higher expenses in certain areas. So we made adjustments here in this financial statement, in this income statement, to look like what it would like if we were owning this particular company. And consequently, it shows that we are going to have about $112,000 net profit versus the owner in this particular year having an $806 loss. And so therefore, we have explanations about why we think these changes are going to be made. It's extremely important that you figure out what that company is going to need if you own the company versus by having the seller own the company. We take the financial statements provided by the seller and we make an adjustment and project what it would look like if you were running that business. We also take the statement of cash flow and we project our need for cash on a monthly basis. Keep in mind, everything we're looking at is history. And we're not buying history, we're buying the future. And remember that we're not buying this history, we are buying the future. That's extremely important. So if that business is doing terrific today or not terrific today, and you're going to buy a business and get a bargain, what's it going to look like 5, 7, 10 years from now? That's what you're buying. And you got to keep that in mind. So let's look at a future, let's look at a financial statement here. And let's say for the last, let's say 5 years, including 2024, this is the net profit of this particular hypothetical company. Now, if I'm going to buy this company, I'm going to look at it and I'm going to look at it from the future. And I'm going to project a 5.4% increase in sales each year. So in 2025 to 2029, I'm going to show a loss in this company over the next 5 years, which is not very good. But if you look at this slide, we're then going to project out why this loss has occurred. Again, we are going to restructure this P&L, and we are going to evaluate where that loss came from. And we can see that loss really is contributed to depreciation and amortization, which is on the tax return, but not necessarily on the P&L statement that you get from QuickBooks or any other software. So that's why it's important you get both the tax return and you get the financial statements. So what we're saying here is that because depreciation and amortization is not a real cash effect, except it reduces your taxes and therefore it creates cash in your pocket from the standpoint of reducing the amount of taxes that you pay, but it has really no bearing on the real operational profit or loss, the real operational profit and loss. And when we take out that depreciation and amortization from that business, notice the profitability and how it has changed. Notice that we just take 1 year, 2029. Notice that instead of losing $23,000, we now are making almost $100K. Now, not only have we adjusted or reconstructed this income statement, look at the add backs. We have added back a little bit of officer salaries. So this officer takes out $60,000 a year. Well, maybe we're going to take out more, maybe we're going to take out less. Maybe the first few years, we're not going to take out much at all because maybe we have a loan. Maybe we're going to have more interest to pay because maybe we went and got an SBA loan, which we'll talk about towards the end of this webinar. You need to reconstruct the financial statements so that you can understand where the numbers came from, what the real profit loss of the particular business is that you're thinking of buying, and how it will look if and when you buy that business. This is a perfect example of how this loss of $23,000, $18,000 is not a real cash loss. And in fact, that business, from an operating standpoint, we call this really EBITDA. We call this EBITDA, earnings before interest, taxes, depreciation, and amortization. This is the real operating profit of the business. In other words, the business has really made $98,000, $96,000, $94,000, and all the other stuff in there is not from its operation. Very important that we reconstruct these financial statements. Let's look at another reconstruction here. Notice that in the yellow area, I have four different rating organizations. These are organizations that show me what the comps are of businesses that were sold of this particular industry over the last 5 years. And I took the same revenue that this business was doing in 2022, $99 million worth of revenue. And according to the rating industries, BBF, BizComps, DealStats, and BRG, and these are all available at your library that you can look them up, this profitability should have been about 24%. Notice that the profitability in 2022 of the business was only $807,000. It was only 9% of revenue, 9% of revenue. And the reality is this company should have shown a 24% of revenue, which is an average here over the last 4 years of all four of these rating companies. And they're not really rating companies. They're companies that actually have dollar bill numbers of businesses that were sold during a particular period of time of that particular revenue stream. So it gives you a good understanding, hey, this business that I'm buying is only earning 9% ROI, return on investment, and the businesses that were sold over this same period of time should have been earning about 24%. So I then go back to the previous slides and the previous information, and I then dig deeper in doing my due diligence to find out why there is this 15% difference in percent revenue of the income. Notice again, there's a huge difference here. We need to do our due diligence and figure out why. So when we get into the industry comparisons, which is what you're going to do, and how do you get this stuff? Well, you can get this stuff at your library. Most libraries have it online, or you can get a hold of a business broker, and they're going to have all these databases for you, and they're going to provide it to you. Do you have to sign a contract with the business broker to get it? Not typically, but you got to find a business broker, let them know you're looking for a business, and they will help you in this evaluation. What we're talking about here is we're looking at how to evaluate the expenses of a business as a percent of its income. Now, we're looking at, on 2023, a business that has revenue, which is 100% of revenue, and we're looking at the cost of sale, we're looking at gross margin, and we're looking at all the different percentages of that revenue. And we are looking also at the multiple of the EBITDA, earnings before interest, taxes, depreciation, amortization, as compared by BizMiner and IBISWorld. And we'll talk a little bit more about them. BizMiner and IBISWorld are also available at your libraries. I get it at the Florida Gulf Coast University Library, and I also get it at the Lee County Library, because we're in Lee County down here in the Southwest Florida area. They will give us multiples of EBITDA that were sold in our industry. And it's all you have to do is plug in the NAICS code, NAICS code, and it gives you this information. So what does this tell you in the yellow highlighted area? It tells you that businesses in your industry were selling and did sold for 2.05 of its EBITDA. 2.05 of its EBITDA. So if the EBITDA was, let's say, $1 million, that means the net profit from the operations, the EBITDA, then the business is selling at 2.05 times that $1 million. These are guidelines that you can use of understanding how much I should pay for that business. We'll give you different guidelines also as we go along. Notice also that this is based upon gross revenue groups. So the one I have highlighted is revenue under $2.5 million. Then if you go to sales groups between 2.5 and 24 million, you're seeing a different multiple of 3.09. And if you go to over 25 million, you're seeing a 3.09 also. So what we're seeing here is a lot of information that's available to you that you need to do your due diligence to pick up, to understand how much am I going to pay for that business, and am I going to buy that business? Because we'll talk about some other issues also. Let me look at the time. Do you want to stop at this point in time and see if there's any questions in the chat?
Sure. There's two things. Somebody asked for an NDA document. If there's a sample that potentially you could share.
I'll say that again.
The NDA document, if you have a sample that you can share for a common NDA. I don't know if you have that.
Oh, sure. We can send that to you, but you can just Google a NDA and you'll be able to find hundreds of them. Okay. They're out there on the internet. Excellent.
They also asked if there's any preferred franchise that you've worked with in the past that are profitable.
Well, there's a lot of franchises that are profitable, but can you afford them? That's question number one. And the libraries have a database of all the franchises available and the profitability of them and the cost of them. So again, this is your due diligence. Again, when I say the library, they're all online. All these databases are online. And that's what I would do. Also, you can connect with several of the franchise brokers. I know one is called FranNet, FRANNET, but you can Google franchise brokers. Keep in mind that when you talk to them, they will only give you an idea of franchises that they represent. So you need to talk to a multiple of franchise brokers because they will all represent different brokers, different franchises. But yeah, the financials of all the franchises are online. There's a whole compilation of them and their profitability and what it costs to buy them and the requirements to get into those particular franchises. So yeah, all that is available to you. Anything else?
Two more. I think it was two screens back when you were kind of comparing the value. They asked, "Is this called value add?" When
Is it called value add?
Yeah.
No, it's not called value add. It's let me go back to those two screens. Is this the right one?
I think it's this one, yeah. In evaluations, yeah.
Yeah, this is not value add. This is just an analysis of a particular income statement and adding back what I believe should be added back to come out with a true net profit. That's all it is. And these are all hypothetical companies.
Got it. So Rexley actually here on evaluations, also back on evaluation screen, where did the future projections come from in the depreciation amortization row?
Oh, okay. Great question. So let me answer the second piece of it. Second piece of it is the depreciation and amortization comes from the assets that were bought or that you're going to buy in the business. So when you buy a piece of equipment or an asset, you get to depreciate it over a period of time. Sometimes it's 5 years, sometimes it's 7 years. So that's where the depreciation comes from. The amortization comes from the goodwill that you purchased when you bought that business. So you're allowed to amortize that goodwill over 15 years. So amortization is different than depreciation only in the respect that it's allowing you to deduct the cost of something over a period of time. Amortization is of an intangible, in other words, goodwill, patents, copyrights. Those are intangibles, so we use the word amortize instead of depreciate. And depreciation is for fixed assets, things you can touch, furniture, equipment, computers, buildings, even buildings. And that's where those numbers come from.
Neil, for that. And lastly, Armin asks, so the valuation of a company and deciding how much to pay is based on the comps?
Oh, the valuation of a business is typically based on a multitude of things. Number one, it's based upon if you're buying a asset sale, it's based upon the assets that the business has, and typically we use the depreciated assets, and it's then based upon the cash flow, because we're interested when we buy a business not in the net profit, but we're interested in the cash flow. And we'll get into that a little bit later on into the slide. But so we take the cash flow of the business and we look at what kind of return we want on our investment. And that's how we come up with the multiple. So if we look at the cash flow and we want to say we want to make a 25% return on our money, that says that we are willing to pay 4 times the annual cash flow, because 4 times is 25%. If we're willing to only make 20% on our return on our investment, then we're willing to pay 5 times the annual cash flow. So that's kind of the multiple. The multiple is the 4 and the 5. The reality is there's a lot more things that come into effect in valuing a business. For example, when you're valuing a small business like we're looking at here, there's a lot of risk factors. The risk factor is, number one, you're buying something that is not, let's say it's not easily liquidated, which means it's not easily gotten rid of. You can't sell it easily like you could a stock on an open market. So if I bought something on the NASDAQ, I could sell that stock and I can liquidate it in 5 seconds. It's very difficult to sell a small business. So you are buying a fixed asset, really a small business, and the risk factor of being able to dump it is factored into increasing the decreasing the price or increasing your return of that investment. So we throw a lot of risk factors in. We throw a lot of risk factors in to value to officially value the business before we come up with the price.
One more thing, Neil, and then we can continue on. How does one quantify goodwill value? I think that's when you were talking about devaluation and more.
That's a good question. Mostly what we do is we value a business in total, and then we take the depreciated value of the assets and we work backwards, and the difference between what we're paying and the actual the depreciated value of the assets becomes the goodwill on our tax return and our financial statement. So anything you're paying more than what the value of or the depreciated value of the assets are is considered goodwill.
Thank you, Neil.
Okay, so now that we finished looking at this, then we're going to go into another item here that you need to understand. So far, we're looking at all your financial statements and we're scrutinizing them. We're recharacterizing them. We're trying to understand how the numbers came there. We're digging into the weeds of those financial statements and not just accepting them. We're trying to understand, are those financial statements respectable in the future, not in the past? Now, we've been talking about income statements. Now let's talk about a balance sheet. And we're going to spend a little bit of time on the balance sheet. The balance sheet, as everybody probably knows, includes assets, liabilities, and owner's equity. And the reality is I pulled off this owner's equity one and I recharacterized it. And notice that, number one, we have retained earnings in the equity section. What's retained earnings? That's the amount of earnings that has been retained throughout the life of being in the business. In other words, the profit that was retained throughout the life of the business. It's not just 1 year's profit. If you look down at the bottom of the net income, that's the current year. So when you close out the current year, that 123K is going to go and add to that 308K, because that would be retained if the owners kept the net income. If they gave it to themselves, then in fact it wouldn't be retained, but it would the amount that was retained would still go up in that 308K. But the important thing I want you to see about the equity section is that we have, just a minute, I got to admit somebody and I just lost this. The important thing that we have here is the members draw. Well, if you're an S corporation, subchapter S corporation for tax purposes, or a partnership or a sole proprietor, you have a right to take out cash anytime you want. And so consequently, when you take out that cash, it's called a members or owners draw, or members or owners distribution is what it's called on a tax return of a S corporation. Notice that the owners took out $224,000 over the period of the life of this company. So consequently, we need to understand that this business generated more cash than what the P&L shows as net profit, because the owners were able to take out over almost $225,000 worth of cash. So we need to look at all of the financial statements. And when you get to the statement of cash flow, this would show up. So why does that matter? It matters because it's showing you how much cash you may be able to take out of the business other than your salary and other than other ways of taking out cash through use of your automobile, through health insurance, through all kinds of stuff that you have as expenses in the business. So you need to learn and see where cash is being distributed to the owners. So the owners here now are taking out $224,000 plus all their salaries. So in fact, in this particular case, the business is actually generating enough cash for the owners to take out more than what it shows on the P&L. And again, if you looked at a statement of cash flow, it would show you all that. And most people don't even know what a statement of cash flow is and don't even know that it exists in their QuickBooks. And it will show that information. Also, we need to look at the due diligence of the vendor concentration. What does that mean? It means is how much of their business is being purchased through few or a diverse amount of vendors. In this example here, we're looking at the TTM, which is the trailing 12 months of purchases. And we're seeing that 7.3% of those purchases are coming from one vendor. And on the 311,000, 12%, 5.4% is coming from another vendor. We need to understand how concentrated that business is buying their merchandise from. Why is that important? It's important because maybe that vendor won't sell to me anymore. Maybe the competition has such a strong hold on those vendors that if I buy that business, they will convince the vendor not to do much business with me anymore. So you need to understand, do I have a diverse group of vendors that I'm working with, or do I have a concentrated concentrated amount of vendors I'm working with? This affects whether you may want to buy or not buy that business. This is another site called BizComp, and BizComp will show you exactly how much businesses were sold for. And notice that it shows you, first of all, the SIC code or the NAISCA code. It shows you the sales price of that particular company. It also shows you the list price and how much it was sold for. Okay, so it shows you the sales, how much that post office mailbox company did in revenue. It shows you how much they wanted to sell their business for, and it actually shows you how much it actually sold for. Again, all these databases are at your library, and they're all online. And it's important that you understand this to see where you need to be in the ballpark to make an offer for a particular business. And again, you would just type in your NAICS code or your SIC code, it would give you the information about the industry and the business that you're looking at. Now let's get into a little bit of IBISWorld. IBISWorld, in my view, is the #1 resource for finding out information. Why? Because it provides you with industry information, it provides you with economic information, and it provides you with competitive information. And what I did was I took here and just gave you a table of contents of the vast amount of data IBISWorld gives you. And this is, I know, at every library, and it's online. Now, you can't afford to buy this. Our university buys it, and I get it from our university library. So look at what it's giving you. It's giving you an industry at a glance, and you can get this narrowed down by zip code. By zip code. You can get it narrowed down by. It gives you a product and market outlook. It gives you a competitive landscape. It gives you who are the major players in that particular industry. It gives you the operating conditions. And most important, it also gives you the standard key statistics, like industry data, annual changes that are occurring, the key ratios, and also industry financial statement information. All this stuff are tools that you need to use for your due diligence to evaluate, is that business a business that I want to buy, #1, and #2, what kind of price do I want to offer on it? Next, we got to look at ratio analysis of the financials that you're getting from your seller. We have to look at the inventory turnover. How fast is that inventory selling, or is there a lot of obsolete inventory sitting there? Maybe they're doing a lot of business because they're allowing people to charge their business and not paying them. We have to look at the accounts receivable turnover rate of that business. How long does it take to collect the company's money? It's easy to sell merchandise and to sell product if you're not making the person pay you for it. And that's what accounts receivable is. And consequently, if you have very loose credit terms, it's easy to sell product. So you need to understand how long your money is sitting out there with the customer and how long it's taking you to get your money back. Because keep in mind, your EBITDA has nothing to do with cash. Your EBITDA is telling you how much your revenue was, whether you collected the money or whether you didn't collect the money. If you're reporting on the accrual basis of accounting and your accrual basis of taxes, your EBITDA doesn't tell you anything about cash. It only tells you that, hey, I sold this amount of merchandise. It doesn't tell you whether you collect for it or not. And it tells you this is what it costs you for your to sell that merchandise. And it doesn't tell you whether you really paid those bills or not. But this is the profit I made. So it has nothing to do with cash flow. It has nothing to do with how much cash is in the bank. And consequently, you need to understand how fast are the customers paying. We then have to look at the accounts payable turnover. How long can the company hold the supplier's money before they get stuck and not get any credit by that vendor any longer? Because the longer you can hold their money, allows you to work with their money and also allows you to use their money to finance that accounts receivable that the customer is holding your money. And what we do is we do a cash conversion cycle analysis, and that takes all four of these, actually three of these things in consideration, and lets you know how much cash you're going to need during every cash cycle to be able to run your business and pay your bills. Then we got to look at the current ratio and the cash ratio, and we're going to go into that a little bit more in detail. So the current ratio says, okay, I have a balance sheet here. I have current assets, which include cash, accounts receivable, and inventory. And I have current liabilities, which include, which are basically accounts payable. And the current ratio is the division of those two. And we'll talk about that in a few minutes. See. Is this a lot of work? Absolutely, it's a lot of work. And that's why you need to bring in your SBDC, your accountant, and your tax preparer. So let's talk a little bit about where does my cash come from? Now, the business that you're thinking about buying. Cash comes from the cash that you have on hand. Cash comes from accounts receivables. Cash comes from inventory because you got to sell that inventory. But then after you sell it, you got to collect the money for it, and that's called accounts receivable. And then cash comes from accounts payable because your vendors are usually giving you 30 to 45 days. So you're holding their cash while you're selling your inventory and while you're collecting your receivables to pay your expenses. It's a vicious cycle. It's called the cash conversion cycle. And this is the cash conversion cycle. So what we have here is we have an operation cycle, which is the black line. And that's when I get my inventory. And that's when I sell my inventory. The red line is the cash conversion cycle, which says this is when I paid for my inventory, and this is when I collect my money from my receivables. Notice the cash conversion cycle is shorter than the operating cycle because the operating cycle has nothing to do with cash. It just says, okay, I bought inventory and I got it, and I sold inventory. It has nothing to do with when you collect your cash. Okay, now let's talk about this. Do you want me to stop and maybe have a few questions there? Because this stuff is.
Yeah, so just really quickly, I have two questions. What industries and business models have you seen lately showing a steady cash flow / profitability in this economy? That's the first question.
Say that again. Say that again.
What industries or business models have you seen lately that are showing a steady cash flow and profitability in this economy?
Oh, okay. Profitability is quite different than cash. That's the first thing. So profitability is determined by how well you're running your business. Okay. So profitability is the difference between what you're spending to run your business versus the revenue you're running your business for. Cash is how fast your cash is coming in. It has nothing to do with one is very little related to the other. What you're asking me, what industry in this economy? IT managed services is a high profit, somewhere around 34 to 35% profit, and a high cash business. Why is it a high cash business? Because they have recurring revenue. They have contracts that they sign. Managed services means that they're coming in and managing your IT service. They're managing your Wi-Fi, they're managing your equipment, and they're doing it all through technology. So consequently, it's a very high profit business, and it's a very high cash flow business because you're collecting that money all the time, and you have no accounts receivables because you're pulling that money, and it's being pulled automatically through technology. So it's being pulled through ACH. The other kind of business that's very, not, I won't say very profitable, but I'll say very high cash flow is online selling of products. Why? Because they're typically operating at a positive cash flow because they're typically getting their money before they even have to buy the product. So you go online, you buy something on Shopify or someplace else, you're paying for it immediately when you order it. That means the company has the cash before they even got you the merchandise. And consequently, that's positive cash flow for the business. How profitable it is, I won't tell you. Any other questions?
Yeah, one more. Armin asks, is this working? It's called working capital. And when you buy a business, how do you agree on what the seller leaves as working capital? I'm not sure what he was referring to. That was a couple minutes ago.
Answered by the next few slides, but working capital, as you see on this slide, is cash, accounts receivable and inventory, and accounts payable. Working capital means this is the assets that you need to run your business. For example, if I'm a retail store or if I'm an online store selling product, I need cash, I need accounts receivable, and I need inventory, or I wouldn't be able to sell my business. Without inventory, I can't sell it. I have no product to sell. Accounts payable means that I am able to put off my vendors and use their cash to be able to buy my inventory and to pay my expenses. So what we say here is that this is called working capital. It's capital that you need to work with to run your business on a day-to-day basis. Okay?
You, Neil.
So if we take a look at this working capital, we're looking at liquidity. We're looking at how liquid is that business that I'm going to buy really, how liquid is it? In other words, is it going to provide me the kind of cash I need to be able to pay my bills? Now, we're no longer talking about profit. We're talking about cash flow. So we need to measure the cash flow that the firm has, and that's done through the cash flow statement. Will the firm be able to pay its current bills in the future? Will you be able to? Will the financial institutions use this to evaluate the business's ability to repay its loans? So yes, the financial institutions will use your cash flow that's coming in to evaluate whether you can get that loan to be able to buy the business and to operate the business so that they will be able to get repaid. They're only interested in getting repaid. That means interest and principal. So let's look at an example of working capital. Working capital is current assets minus current liabilities. So what we're saying here is, if the result is positive, then in theory, the company will have enough cash to pay its bills. That's in theory. In theory, if I have more cash current assets than I have in current liabilities, in theory, I'm going to have enough cash to pay my bills. So why is that a theory? Because if you look at this, if the number on the top is more than the number on the bottom, I should have enough money to pay my bills if, and this is a big if, my receivables come in and I can sell my inventory. Because both those receivables and the inventory have to be converted to cash for me to be able to pay my bills, okay? So that's the theory. So let's look at the theory here. Let's say that I have, now we're looking at balance sheets, we're not looking at the income statements. So let's say that I have here a current assets of 300K. Notice there's only 50K in cash, and the other 250K is in non-cash assets, but what we call liquid, because they can be converted to cash within 12 months. And that's the operative. Could it be really converted into cash within 12 months? And then they have their vendors that they have to pay $80,000. So when they look at this particular situation, we're saying to ourselves, okay, I got company A and company B. They have the same current assets, same current liabilities, but which one's in a better position? Well, I would take company B to buy. Why? Just from this particular scenario. Why? Because look at the difference in cash versus the difference in cash in the company A. Look at the difference in the accounts receivable. Company A has twice accounts receivable as company B. Well, how do I know the company A's receivables are going to all come in? Maybe only 80% of it or 75% of them are going to come in. We don't know that. I have a reduced risk in company B because they only have 50K. Let's go a little bit faster here because I look at the time, but let's look at this. They both have a current ratio of 3.75, but which is better? Notice that 3.75 isn't telling me anything. This is telling me something. Again, I got to look at my due diligence and dig into the weeds of those financial statements to understand company B is a better 3.75 than company A from a cash position. That's number one. Now let's look at another situation. Another situation is, let's look at a different company A and a different company B. They both have current liabilities of $80,000. Company A has your 300K and company B only has 225. But look at the difference in the type of current assets that they have. The type of current assets. Company B has only $75,000 worth of inventory, and company A has 150. What does that tell you? It tells you that company B is able to have less inventory and generate the same revenue, which means it turns it faster. It turns it faster. Is that good? Absolutely. So let's go to the next slide, which shows you that company A, yes, has a 3.75 current ratio, and company B only has a 2.81. Well, if you're only looking at the ratios, company A is better because it's got $3.75 worth of current assets over $1 of current liabilities. And company B only has $2.81 of current assets with $1 of current liabilities. But which company is in a better situation? I need to understand why if I'm going to buy that company. I need to understand why if I'm going to buy that company. Again, you need to dig into the weeds. So we're getting towards the end here, so stay with me, okay? So how to finance your business? Well, we can go to family, friends, and fools who want to invest in you. We can do bootstrapping, which means that you're going to figure it out and finance it yourself. Or we can go into the internet and go to places that help companies finance businesses. Or you can go to the SBA. And the SBA offers two major types of loans called 7A, which is operating loans and loans for your inventory and operating capital, and 504 loans, which is to buy buildings and equipment. Usually they're loans for 3 to 5 years. Another way to finance a business is to be seller financed. Seller finance means that they're carrying a piece of the money. And there's a lot of different arrangements to work with on seller finance. Seller finance should have an earn-out arrangement. An earn-out arrangement means that you are going to earn the money to pay them back every year, and you're going to have some kind of trigger to say, hey, maybe I bought something that isn't really generating the kind of revenue it was supposed to generate. And after the first year, you make an adjustment to the amount that you're going to pay for that business. And when you get these slides, go to this slide, understand it, because it's very important to put an earn-out arrangement in your buy-sell agreement if the seller is carrying your money. You want to make sure that you're protected on the amount of revenue that that seller is showing you and telling you that you're going to make. And if not, great, we're going to adjust the amount of money I'm going to pay you for the remaining 4 years if it's a 5-year earnout. Okay? This is the SBA loans for most needs. They provide fixed assets and working capital loans. You can get all this information to sba.gov. They are your resource partner. They're also our resource partner. You can get loans in all different kinds of areas. They have VA loans. They have special loans for women businesses. They have special loans for veteran businesses. You can go to the SBDC to help you, and you can also go to SCORE to help you find these, get this information. Keep in mind that the SBA typically does not loan money. The SBA helps the bank loan you the money by guaranteeing to the bank a certain percent of their risk of loss. So if I'm going to the bank for $1 million loan, the bank's going to go to their in-house SBA specialist and say, I like this loan and I want to give $1 million for it, but I don't want to take 100% risk of default. Will you pick up an XYZ risk with us? Let's say it's 35% they're asking the SBA to do. So the SBA will evaluate the loan, and they will come back to the bank and say, you know, we like the loan too, but we're only willing to guarantee 30% of the risk of loss of that loan. The bank will then come back and decide whether they want to give you the money. So the SBA helps by helping guaranteeing some piece of that loan, or the bank may not give it to you. So they're a real asset, the SBA. And you can get all this stuff at the SBA.gov. Okay? So in conclusion, buying a business is a process. It must be well thought out. It's not just a matter of, I like this business, these are the financials, I have the money to pay for it. Professionals must be involved, and you never let your emotions drive your decision. And you have to let the data drive your decisions. I know I went through a lot of stuff here real fast because I noticed I'm way over time, but it's a very, very important issue. I'm only really 10 minutes over time. I want to mention to you, if you look at this slide, that we have another webinar coming up on July 8th. It's called Financials, Capturing Their Value, Meaning, and Impact to the Business. And you can go on this website to register. If you have a minute, I'd like you to take your cell phone and camera and capture this to do an evaluation of this particular webinar. And I'm all done, Allie, if you've got some questions.
Thank you. Thank you so much, Neil. Just 2 things. Joshua Richards has a quick question. So I'm going to ask him to unmute his mic. And then if you can go back one more slide real quick, Neil. they're asking the website to book the next class, and I'll go ahead and drop it on the link. Actually, everybody
Oh.
that is on this website, I mean, on this webinar, I'm sorry. I will be sending the YouTube link of the presentation, and in that email, I will also be sending the information for the next webinar also to register. And I think let's go ahead and ask Joshua, go ahead and ask your question, and then there is one other question that on the chat that I wanted you to answer, Neil. Go ahead, Joshua.
Yes, hello. Can you hear me?
I can hear you. I'm
can.
expecting so I can see you. Okay?
Yes. I had a question regarding the SBA towards technology. Do they see that as an asset, or is that not one of the businesses that they really fund?
When you say technology, what do you mean?
Software, health, telehealth, telemedicine, SaaS.
In other words, you want to buy or build a business, and you need the software to be able to do it?
I want to buy existing telehealth or telemedicine
Oh, yeah,
tech business.
sure. They're not really looking at the software. They're looking at the business and what it has to offer. And if you can give them the appropriate financial statements, they'll evaluate whether they want to loan the money on it. But you're not looking at the SBA, you're going to your local bank.
Okay, thank you.
Yeah.
And then last question, I just want to be mindful of everyone's time. Which resource do you recommend to find businesses for sale?
That's a good question. And I would go and I would search the website for franchise brokers and business brokers, and they will have a huge amount of businesses that are up for sale. Also, as I said on my webinar last Tuesday, yeah, I would certainly check your local chamber of commerce, because they know every business within their city. For example, the Naples Chamber of Commerce, the Miami-Naples Chamber of Commerce, the Lee County Chamber of Commerce. They know every business, so they know what's up for sale and what's not up for sale.
Thank you so much, Neil, again for your time. Thank you so much, you all, for joining us, and we look forward to seeing you all in July. Have a great
Okay.
rest of your afternoon. Thank you, guys.
Okay, thank you.